This Hayako tutorial is going to discuss how you can take a proactive approach to credit risk management. I'll talk about 6 specific actions you can take to manage your company's credit exposure. We have several learning objectives for this tutorial. First of all, I'll provide an overview of what I mean by proactive approach to credit risk management. We'll talk about leveraging stakeholders in the company who have a direct relationship with your customers, the importance of keeping credit policies and procedures up to date and communicating them throughout the organization. Then we'll review proactive actions you can take to manage credit risk. So let's get into it. This is a time for credit managers to demonstrate your unique value to the organization. You have a unique domain expertise that nobody else has. As we all know, accounts receivable is your company's working capital lifeblood. You manage the liquidity, a large part of the liquidity for your company. During economic uncertainties like we're going through now, proactive credit management is really an essential part of your working capital management. Cash and borrowing constraints make credit decisions even more important and a real priority in terms of how you manage your credit. So let's talk about what does it mean to be proactive. First of all, act if there are changes in the payment habits, particularly of your vulnerable customers, ones that may be teetering on bankruptcy, or they're very vulnerable to liquidity issues, which could prevent them from being able to pay their obligations. Question unwarranted deductions. These may be just a stalling tactic. So take a look at customers with repetitive deductions. When you find that they're unwarranted, why? Are they just stalling and delaying their payments to you? Conduct more frequent reviews of customer payment trends to other suppliers, either within your industry or even outside the industry. You can do this by comparing notes with your industry group, or periodically looking at credit reports and looking at those trade lines to see if in another industry maybe payments have slowed, and that is basically a warning sign that you may be next. Investigate when there's reported collection agency or legal referrals, there's a judgment against a customer, or other creditor liens. These may not mean anything. They may be, inconsequential, but they could also be threatening to your customer's future. Confirm the lending arrangements that your customers have periodically. What is their borrowing capacity? They may have a large lending line, but it might be at capacity. What is the payment experience with their lender? Is it changing? Is it current? And understand the lending formula. This is something that really tells you a lot about how a lender feels about the creditworthiness of your customer. If, for example, a lender is providing lending against a very high percentage of accounts receivable and a high percentage of inventory, then that says that they feel pretty good about this customer. However, if the percentages are very low, this tells you that the bank is concerned, something that might make you want to take a closer look at that customer. Increase the communication throughout your company. Keep everybody that needs to be aware of the risk related to payment delays and potential bad debts. This could be threatening not only to a salesperson, but to others, where there's going to be disruptions in shipments. You're not going to meet your cash forecast. You're not going to meet your revenue objectives because product may be held in your warehouse awaiting a release of a credit hold because of a customer having liquidity issues, or even worse. Be sure your customers understand, what do they need to maintain a steady flow of product or the services that your company offers. What are your expectations in terms of adherence to your credit lines and your credit terms? Emphasize internally and to your customers how important it is that they keep you informed. If your salespeople are out at an account and they hear of a layoff, or they hear that a customer has lost one of their major accounts. This could really be useful information to you. Develop a good rapport with your customers. That, business goes up and down. If your customers are running into difficulty and they feel comfortable discussing that with you, you can work through those issues. It doesn't mean that it's going to be a catastrophic issue if you can work with them. So try to emphasize with your customers that good communication back when there are issues is really to both of your benefits.